S-Corp versus LLC. Which saves more on taxes? You're running your business as an LLC and paying yourself $100,000 a year, but I just ran the numbers and you're overpaying the IRS by $7,650 annually because you don't understand the single biggest tax difference between an LLC and an S-Corp, and this one decision could save you over $150,000 in the next 20 years without changing a single thing about how you run your business. And here's what makes this insane. The IRS literally published guidelines that tell you exactly when to make this switch, but 73% of small business owners have no idea these rules exist, so they're paying self-employment tax on every dollar they earn when they could legally cut that tax bill in half. Let me show you the exact math, the exact thresholds, and the exact moment you should be making this change. First, let's get clear on what we're actually comparing. An LLC is a legal structure. It's how your business is organized for liability protection. By default, if you're a single-member LLC, the IRS treats you as a sole proprietor for tax purposes. If you're a multi-member LLC, you're treated as a partnership. An S-Corp is a tax election. It's not a different legal entity, it's a different way of being taxed. You can be an LLC that elects S-Corp taxation. You can be a corporation that elects S-Corp taxation. So when people ask LLC or S-Corp, what they're really asking is, should I keep my default tax treatment or should I elect to be taxed as an S-Corporation? Here's the default LLC tax situation. You make $100,000 profit in your business, all $100,000 gets hit with self-employment tax, which is 15.3%. That's Social Security, 12.4%, and Medicare, 2.9%. So you're paying $15,300 in self-employment tax plus your regular income tax on top of that. If you're in the 24% income tax bracket, your total tax on that $100,000 is roughly $39,300. You take home $60,700. Now, here's the S-Corp tax situation. You make the same $100,000 profit, but now you split it into two parts. A reasonable salary, let's say $60,000, and distributions, $40,000. You pay self-employment tax only on the $60,000 salary, not on the $40,000 distribution. That's $9,180 in self-employment tax instead of $15,300. Your income tax stays roughly the same, but you just saved $6,120 in self-employment tax. That's the magic. That's the entire game. Let's go deeper into why self-employment tax is crushing you. When you're an employee at a company, you pay 7.65% in FICA taxes, Social Security and Medicare, and your employer pays the other 7.65%. Total, 15.3%. When you're self-employed, you are the employer and the employee, so you pay both halves, all 15.3% on every dollar of profit. Make $50,000, pay $7,650 in self-employment tax. Make $100,000, pay $15,300. Make $200,000, pay $18,228. Social Security caps at $168,600 for 2024, but Medicare continues. This is on top of your regular income tax. It's brutal. The S-Corp loophole. The IRS says S-Corp owners only have to pay self-employment tax on their salary, not on their distributions. So if you can justify paying yourself a $60,000 salary and taking $40,000 in distributions, you just saved $6,120, 15.3% of $40,000. But here's the critical part. Your salary has to be reasonable compensation for the work you do. You can't pay yourself $20,000 and take $180,000 in distributions when you're the only person doing all the work. The IRS will crush you. What's reasonable? The IRS looks at what similar businesses pay for similar work, the amount of time you spend working, your qualifications and experience, the complexity of your business, and industry standards.
General rule of thumb, 60-40 split, 60% salary, 40% distributions. Some people do 50-50. Very few can justify going below 50% salary without major audit risk. Here's the threshold formula. The general consensus among CPAs is that S-Corp election starts making sense when your net profit is around $60,000 to $80,000 or more. Why? Because there are costs to running an S-Corp. Payroll processing, $500 to $2,000 per year. Additional accounting fees, $500 to $2,000 per year. Potential state fees and taxes, more complex tax returns, more administrative work. If you're only saving $3,000 in self-employment tax but spending $2,500 on additional costs, the juice isn't worth the squeeze. The break-even calculation. Let's say you make $60,000 net profit. As an LLC, $60,000 times 15.3% equals $9,180 self-employment tax. Savings, $3,060, minus costs of roughly $1,500 equals $1,560 net benefit. Not amazing, but you're starting to see benefits. Now, at $100,000 net profit, as an LLC, $100,000 times 15.3% equals $15,300 self-employment tax. As an S-Corp with $60,000 salary and $40,000 distribution, $60,000 times 15.3% equals $9,180 self-employment tax. Savings, $6,120, minus costs of about $1,500 equals $4,620 net benefit. Now we're talking. At $150,000 net profit, as an LLC, $150,000 times 15.3% equals $21,195 self-employment tax. Social Security caps, but Medicare continues. As an S-Corp with $90,000 salary and $60,000 distribution, $90,000 times 15.3% equals $13,770. Savings, $7,425. Minus costs, $5,925. Net benefit. The higher your profit, the more you save. Before you rush to file S-Corp election, understand what you're signing up for. 1. Payroll requirements. You must run payroll for yourself. That means W-2s, quarterly 941 forms, unemployment taxes, workers' comp in some states. You can't just transfer money to yourself anymore. It has to go through formal payroll. You'll need payroll software like Gusto or QuickBooks Payroll. This costs money and time. 2. Reasonable compensation audit risk. If the IRS thinks your salary is too low, they can reclassify your distributions as wages and hit you with back taxes, penalties, and interest. You need documentation showing why your salary is reasonable. 3. More complex accounting. S-Corps require more detailed bookkeeping. You need to track shareholder distributions, loans, basis calculations. Your accounting fees will go up. 4. State-level complications. Some states don't recognize S-Corps the same way the IRS does. Some states have franchise taxes or additional fees for S-Corps. California charges $800 per year minimum franchise tax. New York has additional taxes. Check your state rules. 5. Less flexibility with losses. In a bad year, if your LLC loses money, that loss passes through to your personal return and can offset other income. With an S-Corp, you still have to pay yourself a salary even if the business loses money, and there are limitations on how losses can be used. 6. Required formalities. S-Corps require corporate minutes, shareholder meetings, even if you're the only shareholder, documented decisions. If you don't maintain these formalities, you risk losing your S-Corp status or piercing the corporate veil in a lawsuit.
Oh, who should choose what? Stay as a default LLC if your net profit is under $60,000. You're just starting out and revenue is unpredictable. You have irregular income. Some months great, some months terrible. You don't want to deal with payroll complexity. You're in a state with punitive S-Corp taxes. You prefer maximum simplicity. You're planning to convert to a C-Corp soon for venture funding. Elect S-Corp taxation if your net profit is consistently $80,000 plus. Your income is relatively stable month to month. You're willing to run payroll and handle the administrative burden. You're comfortable with increased accounting complexity. You plan to keep this business structure for multiple years. The tax savings, after costs, are at least $3,000 to $5,000 per year. You have good bookkeeping systems in place. The sweet spot, $100,000 to $500,000 in net profit, is where the S-Corp election shines brightest. You're saving $5,000 to $30,000 per year in taxes, and the administrative burden is manageable relative to the savings. Above $500,000, you might start looking at C-Corp status for other reasons: retaining earnings, fringe benefits, planning for sale or acquisition. Special considerations. Real estate investors, often better as LLCs unless you're flipping properties as a business. Rental income isn't subject to self-employment tax anyway. E-commerce businesses, great candidates for S-Corp if profitable. Easy to run payroll, clear business operations. Service businesses, consultants, coaches, agencies, perfect for S-Corp. High profit margins, clear, reasonable salary benchmarks. Side hustlers, stay as LLC/sole prop until you're making $60,000 consistently. The complexity isn't worth it for smaller side income. How to make the switch? The S-Corp election process. Step 1. Form your LLC, if you haven't already. Register with your state, get your EIN from the IRS. Step 2. File Form 2553. This is the Election by a Small Business Corporation form. It tells the IRS you want to be taxed as an S-Corp. Timing is critical. To elect S-Corp status for 2025, you need to file Form 2553 by March 15, 2025. You can file it when you form your LLC, retroactive election. Late elections are sometimes accepted with reasonable cause, but don't count on it. Step 3. Set up payroll. Choose payroll software or hire a payroll service. Determine your reasonable salary. Set up a payment schedule. Most people do monthly or semi-monthly. Step 4. Update your accounting. Start tracking salary versus distribution separately. Update your chart of accounts. Inform your bookkeeper or CPA. Step 5. Pay yourself properly. Run payroll for your salary with all required withholdings. Take distributions separately, usually quarterly or as needed. Step 6. File the right tax returns. S-Corps file Form 1120S, corporate return. You'll receive a K-1 showing your share of income. You report the K-1 income on your personal 1040, plus your W-2 wages from the salary you paid yourself. Common mistakes? Filing Form 2553 too late and missing the election deadline. Paying yourself too low a salary, major audit risk. Forgetting to run actual payroll and just transferring money. Not maintaining corporate formalities. Mixing personal and business expenses. Not tracking distributions separately from salary.
Advanced strategies, 8:30 to 9:30. Strategy number 1, the timing game. If it's August and you just realized S-Corp will save you money, you might be too late for this year, March 15 deadline. But you can elect for next year, try a late election with reasonable cause. In some cases, use Rev Proc 2013-30 for relief. Work with a CPA on timing. Strategy number 2, the fringe benefits play. S-Corp shareholders owning more than 2% can't get tax-free health insurance through the company like employees can. But you can deduct health insurance premiums on your personal return, above the line deduction. This is a wash, but know the rules. Strategy number 3, the retirement contribution advantage. As a W-2 employee of your S-Corp, you can set up a 401k and contribute as both employee, $23,000 for 2024, and employer, up to 25% of your salary. This can be more advantageous than SEP IRA rules for sole props. Strategy number 4, the multi-state problem. If you operate in multiple states, S-Corp election can get complex. Some states don't recognize S-Corps. Some require separate elections. Some impose additional taxes. Get professional help for multi-state operations. Strategy number 5, the exit planning angle. If you're planning to sell your business in a few years, C-Corp status might offer QSBS benefits, qualified small business stock, allowing you to exclude up to $10 million in gains. S-Corps don't qualify. Think long-term. The decision framework. Here's your decision tree. Question 1, what's your net profit? Under $60,000, stay LLC. $60,000 to $80,000, run the numbers, probably stay LLC. $80,000 to $100,000, seriously consider S-Corp. $100,000 plus, strong candidate for S-Corp. Question 2, is your income consistent? Wildly variable, stay LLC. Relatively stable, S-Corp makes sense. Question 3, can you handle payroll complexity? No, stay LLC or hire a bookkeeper. Yes, S-Corp is viable. Question 4, are you in a punitive state? California, New York, others with extra S-Corp taxes? Factor this in. Most other states, green light. Question 5, what are your long-term plans? Venture funding, stay LLC or planned C-Corp conversion. Stable service business, S-Corp. Plan to sell in less than 5 years? Consider C-Corp for QSBS.
Retire from this business? S-Corp works. The calculator. Your net profit times 15.3% minus reasonable salary times 15.3% minus S-Corp costs equals net savings. If net savings is over $3,000, S-Corp is probably worth it. Solution framework. Here's your action plan. This week, calculate your actual net profit for this year, not revenue, profit. Use the formula. Net profit minus reasonable salary times 15.3% equals potential savings. Research S-Corp costs in your state. Calculate if the savings justify the complexity. This month, if you're over $80,000 net profit, schedule a consultation with a CPA. If you're under $60,000, focus on growing your profit first. If you're in the middle, run detailed numbers. Before December 31st, if you're electing S-Corp for next year, prepare Form 2553. Set up payroll system. Determine your reasonable salary. Update your bookkeeping. For current year S-Corp election, check if you've missed the deadline, March 15. If yes, ask your CPA about late election relief. If no, file Form 2553 immediately.